Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Redwire, ticker RDW.
If you find our talks useful, please consider subscribe, like, and comment underneath. And definitely check out the VIP Algos link below in the description. It's a great tool. So let's just get right into today's analysis. Imagine a company, right, where revenue is just exploding, like up over 33% a year.
Right, which is huge in this environment.
Exactly, and they're locking down these massive recurring military drone contracts. The Pentagon clearly loves them and increasingly views them as a critical domestic asset. So you'd think, naturally, their stock is just skyrocketing.
You really would think so.
But instead, it's collapsed by nearly 70% in just a few months. So the mission for you listening today is to help figure out what exactly is going on here. We're looking at Redwire, a space infrastructure and defense technology company. We need to know, is their current state just a falling knife that you should avoid at all costs? Or is this a high-reward turnaround opportunity for a bold investor?
Yeah, to really understand the sheer scale of the disconnect here, you have to look at the current reality on the tape. As of today, Redwire stock is trading right around $8.45.
Which is brutal.
It really is. That is a drastic, violent correction from its high in May of 2026. Back then, it was sitting all the way up at $26.64. So we're looking at this massive collapse in price, and it's happening at the exact same time the company is aggressively expanding its footprint inside the Department of Defense.
And that top-line growth, I mean, that's where the confusion really starts for a lot of people, right? Because when you look at their trailing 12-month revenue accelerating at 33.58% year over year, you just assume the underlying business model is thriving.
Absolutely.
And it's not just a generic bump in sales either. This growth is being heavily driven by their defense segment, specifically their unmanned aerial systems.
Right, the drone modernization contracts. And the momentum in that specific vertical is... well, it's undeniable. I mean, in the second quarter of 2026 alone, Redwire secured a $21.5 million follow-on award from the U.S. Marine Corps for their Stalker drones.
Wow, $21 million just in Q2.
Yeah, and that Q2 award is simply compounding roughly $20 million in contracts they'd already secured from that exact same program office back in Q1.
So if you look at the aggregate, right, their first half awards for the specific military buying office, the Area RPMO, it sits at a massive $41.5 million.
That's huge.
The defense segment isn't just pulling its weight, it's practically acting as the central engine for their entire revenue narrative right now.
Right.
But let's get into the mechanics of why they are winning these bids over the legacy defense primes. I mean, the big players are always hungry for this kind of unmanned aerial systems revenue, right?
Oh, absolutely they are.
Yeah.
But the differentiator here, the reason Redwire is winning, is structural integration. The defense sector, it isn't like consumer electronics.
Right, you can't just pitch a gadget.
Exactly. You don't just show up to the Pentagon with a shiny new drone and say, you know, here, buy this and win a $40 million contract. You have to be deeply embedded into their existing operational framework. And those Marine Corps orders prove that Redwire isn't just a vendor anymore. They've established this really profound integration into the DoD's supply chains.
So it's not just getting your foot in the door. It's almost like it's like being hired to pour the concrete foundation of a skyscraper.
That's a great way to put it.
Because once the military builds their operational workflows and their training protocols and all their logistics around your proprietary drone tech, the switching cost to just, rip you out and replace you with a competitor becomes catastrophic.
Right. The downtime alone would be a nightmare for them.
Exactly. The military simply won't do it unless they absolutely have to.
And honestly, the Pentagon actually wants them deeply embedded right now, specifically because of their domestic manufacturing footprint. Redwire is building critical defense components inside the United States.
Which is a huge deal right now.
It's everything. In today's security environment, the DoD is hyper-focused on untangling itself from foreign supply chains. So a localized domestic manufacturing capability, it commands a massive premium. It's this structural moat that foreign competitors just simply cannot bridge, no matter how cheap their hardware is.
Okay, so I'm looking at this structural moat. I'm looking at $41.5 million in Marine Corps contracts, and I'm seeing 33% revenue growth. The demand is clearly there, but, and this is a big but, when you flip over to the income statement, the narrative completely fractures.
It really does. It gets ugly.
Right. I mean, a gross margin of 9.18% is bad enough. When you factor in their operating expenses, their net margin plunges to a catastrophic negative 80.9%.
Yeah, negative 80%.
That capital structure is just incredibly fragile right now, which, is exactly why we're seeing a beta of 3.1. Every slight macro tremor is sending this stock violently swinging up and down.
Well, to understand that negative 80% net margin, you have to look at the fixed costs of aerospace manufacturing. It's not like software. They aren't just writing code and hosting it on an AWS server.
Right. Physical products.
Exactly. They are standing up physical clean rooms. They are paying a massive premium for highly specialized, security-cleared engineering talent, and they have to pay them before a single drone ever rolls off the assembly line.
Oh, wow. So the upfront costs are just staggering.
The capital expenditures required to scale domestic aerospace production are just brutal. They consume cash at a terrifying rate.
And that results in an earnings per share of negative $2.26. So we're looking at a company with a market cap of about $2.01 billion, currently trading at a price-to-sales ratio of 5.44.
Right.
I mean, a multiple like that for a company losing this much money tells me they're essentially just buying revenue at a loss. It's like a restaurant with a line around the block, but they lose $20 on every single meal they serve.
That is exactly what the bears are hammering on right now. If your net margin is deeply negative, accelerating your top-line growth just accelerates your cash burn.
Because you're just doing more of a bad thing.
Exactly. Every new stalker drone contract you win technically pushes you closer to a liquidity crisis, unless you can fundamentally alter those unit economics.
So with a net margin of negative 80%, you would expect Wall Street to just demand blood from the executive team. I mean, is there any evidence that management actually understands the severity of this cash burn? Or are they just blindly chasing revenue growth?
No, management is definitely actively attempting to shift the narrative. They've publicly committed to transitioning from this phase of what they call uncertain growth to a period of visible, higher quality execution.
Okay, higher quality execution. That sounds like a corporate buzzword.
It does, but the underlying thesis is that their record backlog of defense orders will eventually trigger operational leverage. The idea is, as they scale up physical production, those massive fixed costs, like the facilities, the cleared engineers, they'll get absorbed by the higher volume.
Ah, so the margins will finally be forced to expand.
That's the plan.
I mean, buzzwords are cheap, though.
Maybe.
I really want to know if there are structural changes happening at the board level to actually enforce that discipline.
Well, we are seeing tangible moves there. They recently appointed Gregory L. Heston to their board of directors.
Okay, who is that?
He's a veteran audit and financial oversight specialist. So bringing a purely financial operator of that caliber onto the board, it's a very deliberate signal to institutional investors. It demonstrates that Redwire is finally prioritizing balance sheet discipline and transparency over just, raw, unchecked growth.
Okay, so with the board stepping in to try and stop the cash bleed, you would think the market might start rewarding the discipline. But when you look at the chart, the market clearly isn't buying this turnaround story yet. The technical damage is severe.
Severe is definitely the right word. Like you said, Redwire is down 68.3% from that 52-week high of 26.64 back in May. Hovering around 8.45 means the stock is currently basing near its absolute floor of 4.87, which we actually haven't seen tested since late 2025.
But despite that massive multi-month correction, the stock is technically still up 11.12% year-to-date.
Right.
Which tells me the intermediate trend is undeniably bearish, but there's a structural floor there. It seems like buyers are stepping in at these lower valuations, absorbing the selling pressure, and basically preventing a total collapse into penny stock territory.
Yeah, and that structural floor is being reinforced by what we are seeing in the trading volume. The current volume regime is aggressively contracting. It's sitting at about 0.47 times the average daily volume.
Why? So volume is basically halved.
Yeah, and when you pair that with a recent 5-day return down almost 12%, it really paints a picture of pure seller exhaustion.
For you listening, this is important, because when volume dries up while the price continues to bleed, it usually signals apathy rather than panic. The institutional funds and the retail traders who wanted to exit this position, they've already liquidated. There's simply no one left who is motivated to aggressively short or dump the stock at these suppressed levels.
Exactly. And that lack of aggressive selling pressure is what creates the environment for a potential base to form. The market has fully priced in the catastrophic margins and the cash burn. Now it's just a waiting game to see if that financial discipline actually materializes.
Speaking of aggressive selling pressure, we definitely need to address a massive piece of market gossip that's generating a ton of noise in the retail space right now.
Oh, I know what you're going to bring up.
Yeah, I saw the SEC filings that Redwire's CEO, Peter Canito, just dumped over 25,000 shares of his own company's stock.
Yeah.
I mean, if you are an investor looking at a 70% collapse and you see the captain of the ship unloading shares, the immediate reaction is to hit the sell button yourself.
And this is exactly why looking at raw data without context is actively dangerous to your portfolio. Yes, the Form 4 filing shows the CEO sold 25,369 shares. But if you actually read the transaction codes on the filing, this was not an open market panic dump.
It wasn't.
No, it was a routine equity withholding tied to restricted stock units vesting.
Ah, okay. So for you listening, this is a critical mechanism to understand when you're tracking insider activity. When executives are compensated with restricted stock, that equity is treated as taxable income the exact moment it officially vests.
Exactly.
So the company automatically liquidates a portion of those newly vested shares just to cover the executive's tax liability. It's a completely automated, non-discretionary transaction.
Right. Canito didn't wake up one morning and decide to abandon ship. In fact, after that automated tax withholding, he still maintains a direct stake in Redwire worth approximately $6.1 million.
That's a lot of skin in the game.
It is. His financial interests remain heavily concentrated and entirely aligned with the long-term survival of the shareholders.
Well, that context completely neutralizes the panic narrative. And I guess it explains why the broader sentiment among analysts tracking this sector remains cautiously bullish. A lot of institutional commentators are looking at this 68% drop and labeling it the best entry point we've seen all year.
Yeah, they are.
They're basically betting that the underlying business model, the 41.5 million in Marine Corps contracts, is fundamentally healthy, and the stock price has simply been punished for the short-term capital expenditures required to actually fulfill those contracts.
But, an exhausted chart and a temporarily punished stock price aren't enough to reverse a downtrend entirely on their own. The stock needs a fundamental catalyst to force the market to reevaluate its pricing model.
Which brings us to the upcoming catalyst calendar. Wall Street is going to be staring aggressively at the Q3 2026 earnings report coming up in that August to September window. And quite frankly, if I'm an institutional investor, I do not care about them announcing yet another massive drone contract.
Right, the revenue is proven.
Exactly. I want to know if they can actually manufacture that drone without setting money on fire. Is there any evidence they can flip that negative 80% net margin?
And margin improvement will be the singular focus of that entire earnings call. Like you said, the market already accepts that Redwire has a world-class defense backlog and a structural moat. The Q3 report is the ultimate test of management's promise to transition into that higher quality execution.
So analysts will just be tearing apart the income statement.
Oh, piece by piece. They need to see if the fixed costs of those domestic manufacturing facilities are finally being absorbed by the increased production volume. If that net margin improves from negative 80% to even, say, negative 40%, the market will view that as confirmation of the turnaround thesis.
Okay, so while the microcatalyst is focused on internal balance sheet discipline, there is a massive macro catalyst looming over this entire sector. The geopolitical winds are basically dictating the fundamental reality of defense procurement right now.
Yeah, the macro tailwinds driving speculation in the defense and space infrastructure space are just undeniable right now. The nature of modern conflict has fundamentally shifted toward unmanned autonomous systems.
It's all drones now.
Pretty much. Just look at the heavy utilization of drone warfare in Eastern Europe. Russia's recent ballistic missile barrage on Kyiv heavily integrated advanced drone swarms to try and overwhelm air defenses.
And we are seeing the exact same strategic shift in the Middle East, too, with U.S. strikes on Iranian sites near the Strait of Hormuz relying heavily on advanced targeting and unmanned capabilities. And just to be clear for you listening, we aren't taking any political or moral stance here. We are strictly looking at how these global events drive U.S. defense budgets.
Right, we're just looking at the realities of procurement. And these events act as a massive structural tailwind for companies like Redwire. When global conflict escalates using these specific technologies, it creates an absolute urgency within the Pentagon.
They see it happening in real time and realize they need to catch up.
Exactly. They observe drone swarms in Kyiv, and they immediately accelerate their own modernization initiatives to ensure parity. That urgency translates directly into expedited emergency procurement for systems like the Stalker drones.
Which bypasses all the usual red tape.
Yes, it bypasses the traditional decade-long military acquisition cycles. The more unstable the geopolitical landscape becomes, the more valuable Redwire's rapid domestic manufacturing capability becomes to the DoD.
Okay, let me push back on that macro thesis for a second, because it relies heavily on sustained instability. What happens if the geopolitical landscape actually stabilizes? I mean, if we see a negotiated ceasefire in Eastern Europe or a lasting diplomatic de-escalation in the Middle East, does the urgency for emergency procurement just evaporate? Does the bottom fall out of Redwire's primary catalyst?
That's a really valid question. A sudden outbreak of global stability definitely introduces risk to the rapid growth thesis. If the immediate threat environment cools off, the Pentagon could easily revert to its standard, painfully slow procurement cycles.
Which means the bureaucracy kicks back in.
Exactly. And that would undoubtedly slow down the pace of new contract announcements for Redwire's drone division.
So the risk of peace is a legitimate financial threat to their cash flow projections.
It is a risk, yeah. But you also have to look at the contractual reality of their current backlog. Defense spending doesn't just turn off like a light switch. Redwire's modernization contracts with the Marine Corps, that $41.5 million, are already locked in and funded for the first half of the year.
Ah, so the money is already committed.
Exactly. Even if global geopolitical tensions plummeted tomorrow, those existing contracts provide a vital short-term financial buffer. The revenue is already secured. Their only job now is to execute the manufacturing profitably.
All right, so we have a deeply polarized setup here. We have a company expanding its top line at 33%. They're structurally embedded in the U.S. defense supply chain, but they're burning through capital at a terrifying rate, resulting in a stock that has just been decimated. Synthesize all of these conflicting metrics for us.
Yeah.
What is the final verdict on Redwire?
Well, based on the synthesis of the data and the underlying financial mechanics, Redwire is a classic high-risk, high-reward turnaround play. Technically, the stock is sitting at a multi-month floor with clear indicators of seller exhaustion.
Right.
Fundamentally, they have secured a record backlog of government contracts and are visibly pivoting their boardroom strategy to address the severe balance sheet bleed. When you weigh the catastrophic profitability metrics against the undeniable macro tailwinds and DoD integration, this setup scores a 6 out of 10 on the bullish scale.
A 6 out of 10. So that means the data leans positive, but the execution risk is still massive.
Definitely. The target horizon here dictates the strategy. This isn't currently structured as a buy and hold for a decade investment. The metrics suggest a swing trade focused squarely on the Q3 earnings report.
Because that's the make or break moment.
Exactly. If management delivers tangible proof of margin expansion in that report, the narrative fundamentally shifts from a distressed asset to a successful turnaround, and the stock price will rapidly re-rate to reflect that survival.
For you listening, this is the core tension you have to navigate. And remember, we aren't here to tell you to buy, sell, or hold this stock. We're just outlining the upside and the downside. You are balancing the brutal reality of a deeply unprofitable manufacturing operation against the undeniable momentum of multi-year military contracts. It is basically a high-stakes game of chicken between their cash burn and their operational leverage.
And the winner of that game will be decided entirely by management's execution over the next 2 quarters.
But I want to leave you with a final lingering thought to explore long after our talk today ends. We spent a lot of time analyzing Redwire's domestic manufacturing moat, how deeply embedded their technology is within the Pentagon's operational framework.
Yeah, that's structural integration.
Right. So as domestic manufacturing and localized supply chains increasingly become a matter of absolute national security, at what point do deeply embedded private tech companies like Redwire cease being just vendors and effectively become sovereign infrastructure?
That's a heavy question.
Because if a private company is building the critical hardware of the U.S. military domestically, how will the broader market eventually price an entity that the federal government simply cannot afford to let fail? It is a fascinating structural question to ponder as you watch that ticker symbol R-DW battle for its margins over the coming months. Thanks for joining us. Don't forget to subscribe and make sure you check out the VIP Algos link below in the description. We'll catch you on the next one.